The Federal Reserve delivered on market expectations for another 75 basis point rate hike. The Fed funds rate now stands at 4%. But what the Federal Reserve failed to deliver was on the expected softening in the Fed's stance on the future trajectory of interest rate hikes.
In October, the United States' leading economic indicators fell 0.8% to 114.9, twice the forecast decline. This is the 8th consecutive month that leading economic indicators have declined. If the U.S. is not already in a recession, this certainly indicates that one is coming. Peter Schiff, who is an American stockbroker, financial commentator, and radio personality, shared in a tweet. 2 weeks ago, the Federal Reserve delivered a 75 basis point rate hike, but Fed Chair Jerome Powell failed to deliver the more dovish rhetoric that many expected. The messaging did not indicate much softening in the stance on the future trajectory of rate hikes, despite an apparent soft pivot the week before. In this video, Peter broke down Powell's messaging and pointed out several very scary admissions that came out of the Fed meeting.
I believe the Fed was forced into making that pivot because it stood on the precipice of a bond market crash, which was in the process of happening. And I think the only way the Fed was able to stop that slow motion crash from playing out and accelerating was by throwing a bone to the markets and indicating through the Wall Street Journal that there was going to be some type of statement that was going to go along with the rate hike that we got today that would indicate that maybe there was going to be a pause in the pace, a slowdown in the pace, that the Fed was going to take a step back and reflect and assess and maybe acknowledge the progress that had been made without indicating complete victory, but at least acknowledging that victory was at least in sight and that the Fed could take a more cautious approach going forward to rate hikes. Something to that effect was expected. However, nothing even remotely close to that was delivered by Powell. Now, when the markets initially got the news of the 75 basis point hike, it was accompanied by an official statement that created some hope that Powell had in fact delivered on what the markets expected. The Dow Jones initially rallied about 400 points. And the reason for the optimism was that the statement read that the committee was going to take into account the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation. And the idea that many people, myself included, drew from that was that, hey, the Fed was now going to take a step back, acknowledging this lag. Rates have come a long way fast, and we need to take a pause and to see exactly what we've achieved before moving forward. Or maybe we're going to raise rates more slowly than we originally thought, acknowledging the lags that take place. It seemed to me, and probably everybody else, that that is the direction that Powell was going to go in the press conference. But it didn't even wait for the Q&A, because as Powell was delivering his prepared remarks at the press conference, but before he went off script and took any questions, he read something that scared the markets, and that entire 400-point rally in the Dow disappeared, and the Dow went negative. And the words that he spoke that spooked the market were that price stability is essential, and the historic record cautions strongly against prematurely loosening policy, and that we will stay the course until the job is done. Now, the minute those words were spoken, the markets tanked. But as Powell started to field some questions, the markets recovered somewhat, not all the way up to the highs, but the Dow got to up about 200 until Powell started really showing his hand, but he wasn't holding the cards that the market had expected.
The Fed has created so much inflation for so long, it didn't even start with COVID. It didn't even really start with QE. The Fed was creating inflation even before it upped the ante to quantitative easing and then upped it again in the aftermath of COVID. Powell also admitted that inflation was a lot higher and has lasted a lot longer than anybody at the Fed had expected.
Powell reiterated the Fed's commitment for positive real interest rates, meaning an interest rate that was higher than the inflation rate. Powell basically said, yeah, that's where we're going. And right now, the Fed funds rate is 4% and the inflation rate is higher than 8%. Now, Powell implied that he believed that we would get to positive real interest rates because of a reduction in the inflation rate. So it wouldn't require interest rates above 8%. If inflation came back down to 4%, well, we could have positive real interest rates at 5%. But what the markets are likely to be afraid of, and if they're not afraid of it now, they will be, is what if inflation doesn't come down? What if it stays high? What if maybe it comes down, but it only comes down to 6%? Well, that means if Powell wants to have positive real interest rates, if inflation is 6%, then we need to go to 7%. And that's a much higher rate of interest than the markets are prepared for or could handle. And so I think the fact that Powell had to acknowledge that ultimately we have to have a positive real interest rate, that is very scary for the markets. Then Powell was asked a question about what he and the FOMC believed was the current underlying inflation rate in the U.S. economy, meaning not the headline rate that we all read about, but beneath the surface, what do you think the rate really is? Because it can't be 8.5 or whatever the CPI is. It must be something lower than that. And so what do you think it is? And Powell's answer was, we don't have a number. Like, we've got no idea. We're clueless as to what the underlying rate of inflation may be. Now, that is a very scary admission by the Fed, because if the Fed is committed to fighting inflation, but it doesn't even know how big the monster that it has to slay is, then how does it know how many rate hikes are going to be necessary? How does he know how high rates have to be in order for there to be a positive real rate of interest if he doesn't even understand what the underlying rate of inflation is? And if he doesn't understand it now, why will he understand it at some point in the future? The Fed has no clue. All it's looking at is the same headline numbers as everybody else. And based on that, the Fed is still way behind the inflation curve and has a long way to go. And that, again, should scare anybody who is counting on the Fed to ease up on its current trajectory of tightening. But then Powell was asked another question about whether or not he believed inflation had become entrenched. And I think the interesting part about that answer is that he didn't say no. You would have thought that Powell would have said, no, it's not entrenched yet. We're just going to make sure that it doesn't become entrenched. No, he never really answered the question with a yes or no answer. In fact, what Powell said eventually was that the Fed has no way of knowing when inflation becomes entrenched. That's another scary admission by the Fed, because if it doesn't know, it's just kind of flying blind, and it has to err on the side of caution to make sure that inflation doesn't become entrenched. But again, all of this discussion about entrenched inflation assumes that inflation is a psychological phenomenon. It's not. Inflation doesn't become entrenched because of psychology. It becomes entrenched because of monetary policy. And I think it already is entrenched. And the reason is because of the Fed. The Fed has created so much inflation for so long. It didn't even start with COVID. It didn't even really start with QE. The Fed was creating inflation even before it upped the ante to quantitative easing, and then upped it again in the aftermath of COVID.
The Fed is willing to tolerate a hard landing and a mild, short recession. But if it gets worse than that, it will use its tools. Peter said he thinks it will use those tools long before inflation gets near 2%. But even in the extremely unlikely situation where the Fed got inflation back down to 2% because of its tightening, and then, with inflation at 2%, the Fed then used those tools to stimulate the economy, anything it had achieved in reducing inflation will be lost and the inflation rate will spike back up again. So, even if inflation does go to 2%, the Fed still can't use those tools. It is only safe to assume that the Fed doesn't even have a plan to get out of the self-dug hole and will be dragging everyone along with it. How well are you prepared to cushion the effect of future monetary tightening and interest rate hikes? Let us know in the comment section below. Don't forget to like the video, subscribe, and turn on notifications. Thanks for watching.